Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. So if you want to know how to do accounting, you've come to the right place. So this lesson is for beginning accounting students. Maybe this is your first or second week of accounting, so this is real basic stuff, but I've got a good way to explain it, and we will get through it here. So here's what we're going to do today. We're working with Fred's Snowblower Service up in Breckenridge, Colorado. This is based on a true business, but the names have been changed to protect the innocent. And Fred is just now starting his business in June. So here are a bunch of transactions that we're going to go through. And then what we'll do is we'll post them to this general ledger. And after that, we're going to do a quick trial balance. You'll see this is very easy. And lastly, we'll do Fred's financial statements. So hang in there, we'll get through this. So I'm going to split the screen so you can see a little bit better here. So I've got the screen split, and what I have is I have a transaction up here in the top part of the screen, and down below I've got the general ledger. Now folks, the general ledger is the heart and soul of accounting. And on the left-hand side, I've got all the assets. And if you've been watching these videos, you should know by now that assets, the way we're defining them at this point, is nice things to have. Assets are nice things to have. Like it's nice to have cash. I like having cash, and I bet you do too. And if you're a snowblower repair service, it's probably nice to have parts inventory and merchandise inventory. What else does Fred have? Fred has some equipment. So everything on the left-hand side are assets, nice things to have. Now, I've got these plus signs on the left-hand side. Look at this. All of these different accounts have plus signs on the left-hand side. Every single one of them. Look at that. Now, it's easy to remember. On the left-hand side are assets, and the plus sign goes on the left-hand side. So it's very consistent. Assets on the left-hand side, pluses on the left-hand side. What that means is when cash comes in and the cash account increases, we'll put it on the left-hand side. And the opposite is true too. When Fred spends money, we'll put it on the right-hand side. Now on the right-hand side of this, we've got liabilities and equity. Liabilities are bills that are due, bills that are owed, liabilities. And we have equity, and equity represents the ownership interest. Now if you notice on the right-hand side, the plus signs are on the right-hand side. And that's a good rule to remember. So assets on the left, plus sign on the left. Liabilities and equity on the right, plus signs on the right. So it's easy to remember. However, there is one major exception to this rule, and it's all the expenses. All of the expenses are underneath equity, but their plus sign is on the left-hand side. And this might be hard to remember at first, but it'll be pretty easy. So here we go. Let's get started. Let's just learn by actually doing it. So transaction number one, Fred deposited $5,000 of his personal savings in a bank as his primary business account. Fred considered the $5,000 deposit to be an investment in his business and received $5,000 worth of Fred's Snowblower Service common stock. So what's going on here? Fred is taking his own personal money, maybe he had it buried in his backyard or under a mattress, who knows where it was, and he put it into the business. So I'm going to put right here under cash, I'm going to put $5,000 because Fred is depositing $5,000 of his own personal money into a business account. So this cash account represents a business account. Now, I've got something on the left, and the whole objective of accounting is to keep the left-hand side in balance with the right-hand side. And that's why I have an equal sign here. So I've got to have $5,000 on the right. Now Fred gave himself $5,000 of Fred's common stock. And so this represents the ownership interest. And Fred's the only owner too. So Here we go. So I've got 5,000 on the left. Look at that underneath the plus sign. I've got 5,000 on the right underneath the plus sign. There we go. So lefties equal righties. Now in accounting language, the way accountants talk, they don't say lefties equal righties, although that's how I explain it. But what they would say is they would say debits equal credits. So the word debit means left and the word credit means right. Now, and if I slip and I say debit or credit, I just mean left or right. That's all it means. It doesn't mean anything more than that. So coming down here to the next transaction. Transaction number 2, Fred rented a store or shop and paid the landlord $1,000. Now money's not coming in, so I'm not going to put it on the plus side of cash, but what I'm going to do is I'm going to put it on the other side. There we go. So Fred spent $1,000. So a good way to look at this cash account, on the left-hand side, where the plus is, this is money coming in. On the right-hand side, that's money going out. So I've got something on the right-hand side here. I need to have something on the left side over here. So Fred is paying rent. Now look at this. We've got an account here, rent expense. There we go, $1,000. So let's look at this carefully, because if you understand this, you're well on your way to understanding accounting here. So I've got $1,000 on the right of this account, so I need to have something on the left. Pacioli, the old Italian guy that invented accounting about 500 or 600 years ago, pretty smart guy, and he realized that if he kept the lefts and the rights in balance, he could keep track of his business. So here I have something on the right, I've got something on the left. So I can say my righty here equals my lefty. So lefties and righties are in balance. And you know what? I've got something over here on this side of this green line. I've got something over here on this side of the green line. So that just helps us make sure that things balance. So transaction number 3, Fred purchased $1,500 snowblower repair parts with cash to have on hand when customers want snowblowers to be repaired. These parts are considered to be parts inventory. So one thing that we know is Fred is spending money. And as I've already said before, but I'll say it again, that when money comes in, it's on the left-hand side of cash. When money goes out, it's on the right-hand side. So there we go, $1,500. Now, what Fred did with this $1,500 is he bought parts inventory. And parts inventory goes right here. Parts inventory, that's a nice thing to have. If you have a snowblower repair shop, it's nice to have parts inventory. So we're going to call that an asset. And equally important here, I've got something on the right of cash. I've got something on the left of parts. So look at this, righty, lefty, it stays in balance. Now check this out. My righty and my lefty, in a sense, they kind of cancel each other out in a way. So I don't need anything at all over here on the right-hand side. And if this all seems confusing, it becomes really easy, second nature. But you got to practice it, got to practice. In fact, it wouldn't hurt to watch this video again. So number 4, Fred signed a contract with a snowblower distributor to sell new snowblowers. Fred purchased 4 snowblowers for a total price of $4,000. These snowblowers are considered to be merchandise inventory. Fred did not pay, but rather the snowblowers were purchased on account. So Fred is buying merchandise inventory. He's going to turn around and sell these snowblowers once it gets cold outside and it starts to snow. So $4,000 of merchandise inventory. So I've got a number on the left-hand side, so I need something on the right-hand side. Now, he's not spending cash, but Fred owes this money. He owes it. So here we go, $4,000. So I've got $4,000 on the right here, $4,000 on the left. Lefties equal righties. And you know, everything on the left-hand side still equals everything on the right-hand side. So we are good. Number 5, Fred made a payment to the snowblower distributor of $250 cash in regard to the 4 snowblowers. Fred will be making monthly payments until the 4 snowblowers are completely paid for. So Fred is spending money. He is spending $250. And what's going on here? Well, he's paying down the account. Now check this out. I've got a number on my right of cash here, a number on my right. I need something on the left. There we go. Look at that. So here's a good way to interpret it. Fred bought $4,000 of snowblowers. He owes $4,000, and he just now paid off $250. So if someone were to ask you, what's the balance in accounts payable, it'd be real easy to figure out. Well, he borrowed $4,000 and he paid off $250, so he must owe still $3,750. And if that's what you were thinking, you would be right. Transaction number 6, Fred signed a contract with the city of Breckenridge to do basic snowblower maintenance during the winter season. Now, it's not the winter season right now, it's June. And the contract is for $20,000, and so far Fred has not completed any work for the city. And the city has not paid Fred any money. The city and Fred have just simply come to an agreement. They signed a contract, but no work has been done. No money has changed hands. So as far as our general ledger goes, and assets and liabilities and equity, we're not going to record anything. Nothing's really happened here that goes into the general ledger. No money was earned. No work was done. No money changed hands. So there you go. Number 7, Fred spent $2,000 to have a business website created and get social media accounts set up. Fred considers this to be marketing expense. So Fred is spending some more money here, $2,000, to get all set up with that. Fred's really good at fixing snowblowers, but he doesn't know very much about social media. And so he had to hire somebody. So look at this, guys. We've got cash on the right-hand side because cash is being spent. And we have marketing expense of $2,000, which goes on the left. So lefty equals righty. Look at that. Left-hand side of this account, right-hand side. Now, you may notice a pattern here, and it truly is a pattern, is that expenses always go on the left-hand side. And that'll help you out. That's a good thing to remember. Transaction number 8, Fred paid wages to an assistant, Sally, $3,000. So there we go. And Sally likes being paid in cash. And let's see if there's an expense, because this is a cost of doing business. In fact, that's what all expenses are. They're costs of doing Fred's job. Number 9, Fred and Sally repaired snowblowers, chainsaws, and weed whackers, earning a total of $15,000. So this is money coming in. All the customers paid with cash. This is money coming in. And when you do your job, you do your work, and money comes in like this, that is revenue. Revenue is money coming in from doing your job. And it's really important before you claim revenue that you do your job first. All right, you got to remember that. A lot of people have gone to prison for forgetting that one little thing, because claiming revenue before you do your job, that's the number one form of financial or accounting fraud. Yeah, a lot of people have gone to prison for that. Number 10, in order to complete the repairs, Fred had to purchase with cash repair parts costing a total of $4,000. Since these parts were consumed, the parts are considered parts inventory. Now, Fred just did a ton of work, $15,000 of work, but he had to use up parts, and apparently he didn't use these parts that were here in inventory, but rather he had to buy some parts. So he spent $4,000 buying parts. Anytime you spend money, it's on the right-hand side of cash. And he used up these parts expense. He used up these parts. Now you might be wondering, what is the difference between parts inventory and parts expense? Well, parts expense, those are parts that were used in doing his job. They were used up. They were installed in the snowblowers, installed into the chainsaws. Maybe he bought a carburetor for a chainsaw, and that carburetor had to be installed in the chainsaw. So parts expense, these are parts being used up. Now the parts inventory, these are parts that are still sitting on Fred's shelf collecting dust. They will be used during the winter, I'm sure, but for now they're just sitting on the shelf collecting dust. They have not been used. That's the distinction. But they're nice things to have, though. It's good to have parts. People come in and they want their snowblower fixed. It's good to have the parts ready. So transaction number 11, Fred had to purchase a drill press, grinder, and air compressor for the shop for a total cost of $3,500. These tools are considered to be equipment. The tools were not purchased with cash, but were purchased on account from Home Depot. So Fred is buying some really nice things to have. I happen to love tools, and I've got a nice drill press and a grinder and air compressor at my house here, which I use all the time. Nice things to have, and they would be especially nice to have if you have a snowblower repair shop. Now, Fred is not paying cash, but rather Fred borrowed the money. Accounts payable. Whenever you borrow money, when you borrow money, that's a liability because you have to pay that money. So on to number 12. Fred withdrew $100 from the business cash account. So that's money coming out. Fred withdrew $100 out of the cash account, called the withdrawal a dividend. Now, withdrawals or dividends, it's the same thing. A withdrawal is when the owner of the company takes money out of the company, and owners can do that. It's their company. And sometimes they're called dividends. Same thing. Fred and Sally celebrated the first month of business by buying pizza and beer. Okay, so good times here. They had a good month. So dividends, $100. So check this out, guys. All these expenses and the dividends here are on the left-hand side. Now, dividends aren't exactly like expenses. They're a little different, but we can get into that later. But dividends behave just like parts expense or wages expense. Look at that. So here we go. So what we need to do at this point in time, because that's all the transactions, we need to find the balances. Now, if you're using Excel, it's really easy to do. Like for cash, you would just add up all the money coming in, subtract all the money going out, and whatever's left over, there you go. So at the end of June, they've got $8,150. Fantastic. And since there was only one transaction in the parts inventory, the balance is $1,500. Merchandise inventory, $4,000. Equipment, $3,500. There was nothing to add up here. Coming over here to the right-hand side, let's look at accounts payable. Well, with accounts payable, Fred borrowed a whole bunch of money. He borrowed $4,000, and then he borrowed $3,500, and he paid down $250. So he paid some of it off. So if you add up what he borrowed minus away what he paid back, you would come up with $7,250. And if you do the math, that's what you get. And if you do it on Excel, Excel will not make a mistake for you. Now, all the other accounts, the balances are already figured out there for you. I mean, there's nothing to add up. All right. So what I'm going to do is, for a moment, I'm going to remove this split here. We're going to double check and make sure the left-hand side, that is everything on the left-hand side of this green strip here, equals everything on the right-hand side. All right. So here we go. Here we go. So what you do is you simply add up all the balances. So cash has a balance of $8,150. Parts inventory, $1,500. Merchandise inventory, $4,000. Equipment, $3,500. All you do is add them up. Now there's nothing else, but that's all there is. And I already added it up here. There it is. So if you add them up, you get $17,150. Again, do it on Excel, folks. Excel will not mess up for you. Now the right-hand side is a little bit more tricky, but not much. So on the right-hand side, we're going to add up these balances. So on the right-hand side, we've got accounts payable, we've got common stock, and we've got revenue. So what I would do is I would add up those three. Just add up those three and get a subtotal. Now what you've got to do is you've got to subtract these expenses. There's a couple of reasons why, but I'm going to give you kind of a nerdy definition of why you have to, okay? Are you ready for the nerdy definition? Well, here's the nerdy definition. The accounts payable is on the right-hand side of the account. Common stock is on the right-hand side. Repair revenue is on the right-hand side. And expenses are on the left-hand side. So expenses are kind of the opposite, right? Accounts payable right, common stock right, repair revenue right. All the expenses are on the left. So the expenses are kind of going against everybody. What accountants would say, oh, accounts payable is a credit balance, common stock is a credit balance, repair revenue, credit balance, and expenses all have debit balances. That's what accountants would say. But all it is we're going to take the righties and we're going to subtract away the lefties. Okay? You can do it. Add up the righties, subtract away the lefties. And don't forget dividends down there. That's a lefty. Now, if you do that and you do it correctly, you get $17,150. So this is all good news. My left side equals the right side. Now I can be assured that I'm probably doing a good job. We could have messed up in other ways, but we're probably doing a good job. So there you go. So we're going to come down now, down to this trial balance. What I'm going to do is split the screen again. Well, let me first of all show you what this trial balance is. So the trial balance is basically what we just did. All we're going to do is if an account has a balance on the left, we'll put it on the left. Debit means left. And if an account has a balance on the right, we'll put it on the right. That means credit. Same thing. Same thing. That's all we're going to do. This is the easiest step in the world. But for some reason, it's the step that people mess up. I don't know why they do. It's so easy. So here we go. Go to view, split. All right, so here's all you do. Cash up here. I'm going to bring this down just a teeny bit more. Now, cash has got a balance of $8,150. So all you do is you take $8,150 and write it down under cash. Now it's on the left-hand side, so put it on the left-hand side. So here we go. That's all you do, right there. Didn't take any math, didn't take any thinking, except you gotta make sure that you don't mess up. If it's on the left, put it on the left. That's all you gotta do. Also, you gotta make sure you write down the number right. 8,150, don't write something else here. It's the same number, 8,150. That, I see so many people mess it up. But it's so easy. Parts inventory, 1,500 on the left, 1,500 on the left here. There we are. Merchandise inventory. This is so easy, guys. 4,000 on the left, 4,000 on the left. Equipment, 3,500 on the left, 3,500 on the left. All right. Accounts payable. Now accounts payable is on the right. So put accounts payable on the right. It's the exact same number. Don't get your digits switched around or something. Common stock, 5,000. All you do is write it down, folks. Revenue is 15,000. There you go. Rent expense. Okay, now be careful. Rent expense is on the left, so write it down on the left. Make sure you don't mess up. Don't write down $100 or $10,000. Write down the exact same number. Marketing expense is 2,000, so we are going to write down $2,000. Wages expense, 3,000. There we go. Parts expense, 4,000. And lastly, dividends, $100. So there you go. So I'm going to get rid of the split. So here's my trial balance. So here's all I got to do, folks, is I got to add up the column. That's all I do. And again, if you're doing this on Excel, it's so easy, folks, and Excel won't mess up for you. If you do it on your calculator, chances are pretty good you're going to mess up. So all you do is add up the columns here. And we're double checking to make sure our lefties equal our righties. And if they do equal, we can be assured we're probably doing a good job. So you might say, so what's the difference here? And we got different numbers up here. Well, we're just doing it a different way. We made sure the left-hand side equaled the right-hand side. And these are the numbers. The important thing is, though, that they are the same number. They balance. And down here, it's just our formatting's a little different. Lefties, righties. And this is the more traditional format that accountants and business owners would do right here. This format here. And this trial balance is actually a pretty nice thing to have. And the most important thing is it balances. So that means we're probably doing a good job. It doesn't guarantee we're doing a good job, but we probably are. So now we're going to come down to the financial statements. So all we're going to do is take information off this trial balance and put them on the financial statements. So I'll scroll down and we'll get all set up. So ladies and gentlemen, here's what I have. I split the screen, and in the top part here, in this little tiny spot up here, I've got the trial balance, and you can see it's all there. But I just want to see a little bit at a time. Here we go. So folks, when it comes to doing the financial statements, we have to start with the income statement. You cannot start any place else. This is it. You got to start here. So what goes on the income statement? Well, money coming in from doing your job and money going out from doing your job. The income statement is all about doing your job. So repair revenue. Revenue is money coming in from doing your job. And there it is on our trial balance, $15,000. So all you do is take the $15,000 and you simply drop it right down there. And then it comes to the expenses. Now here's rent expense, $1,000. So all you do is you put it right down here, $1,000. You don't have to change the numbers. It is not requiring any math. You just transfer numbers. But you have to be careful. Make sure you transfer the number correctly. It was $1,000. Don't write down $100 or something silly, all right? Marketing expense, $2,000. So here we are, $2,000. There you are. Wages expense was $3,000. We just put it here in wages expense. Parts expense, $4,000. Here we go. Try that again, $4,000. Now, folks, do you notice here, I've got dividends. Dividends are kind of similar. They're a cousin, you might say, of expenses. I mean, a far distant cousin of expenses. In a lot of respects, they behave the same way, but we're not including it on the income statement ever. Don't ever put dividends or withdrawals on the income statement, because dividends, that's money going out from just, the owner withdrawing money out of the business. It's just the owner's taking money out for personal reasons. And expenses, that's money going out for doing your job. All right. And the income statement's all about doing your job. So we need our total expenses here, guys. So all you do is you add up the total expenses. $10,000, it's 1,000, 2,000, 3, 4, and it adds up to 10,000. And then we can find our net income. Net income is simply revenue minus expenses. There is our net income. There we go. Now I highlighted this net income in this beautiful blue color because this net income is going to flow over here to the next statement. You see where it says add net income? So this $5,000 is going to flow like a river. Just like the Columbia River up in Oregon. It's going to flow over here just like that. So there we go, $5,000. So I'll just set that number right in there. Now, retained earnings, we have not talked about this. Well, in fact, we have not talked about this statement at all. So the name of this next statement in this green box here is called the Statement of Changes in Retained Earnings. And retained earnings, that's simply the earnings, the profits, the net income that has been generated by the business and that is being retained in the business so the business can grow. All right. Most of the time owners don't want to take all the money out of the business that's earned. They want to leave some money in there so that way they can expand and grow and do really cool things. Now, this is Fred's very first month of business, so he doesn't have any retained earnings at the very beginning, right? None at all. But he is adding the net income, and he is going to subtract out the dividends. So now's the time to subtract out the dividends. All right, so let's put that in there, dividends. There you go, we'll subtract it out. So here we go, the ending retained earnings. So all we do is take beginning retained earnings, which is 0, add the net income, minus out the dividends, and guess what we're going to get? There we go, 4,900. So there's the ending retained earnings. So this ending retained earnings, it tells Fred, the owner, that his net worth in the business is increasing. He's doing well. He's got probably some funds that he can expand with and grow. Now, coming down here to this pink box, I've got the words here, alternative format. So what's going on is that whenever I do financial statements for little businesses like Fred's, I always use this format up here, the one that we just did in the green box. That's just what I do. It's just that simple. But larger businesses do this alternative format, and I noticed that in some textbooks they teach it this way. So I thought, oh boy, I better show you how to do it this way too. This alternative format here, it's really pretty easy. There's nothing to it, but I just didn't want to confuse you guys. So here's what's going on, is that when you're doing the financial statements for a company, you're either going to do it the way we did it in this green box, or you're going to do it the way we're going to do it in this pink box. You don't have to do it both ways. Doing it both ways would be overkill, all right? So you don't have to do that. I wouldn't. And in fact, with all the small businesses that I've ever worked with, I have never, ever used this alternative format, ever. So, but with big businesses, this is how they do it. So here we go. A cool thing about this pink format is this middle column here where it says retained earnings. It's identical to this green box. Totally identical. No different whatsoever. So check this out. Retained earnings, beginning balances here. Well, it was 0, right? And if you can't remember, just look up here at what we did in this box up here. Now, what happened next on this green statement here? We added net income. Added net income. So let's add in the net income. So here we are. And you might say, hey, wait a minute. You skipped over issuing common stock. Well, we'll take care of that in the common stock column. So we won't worry about it, okay? So we're just going to skip right there. And then the dividends, remember the dividends in the green box? There they are right there. So all you do is put dividends right here. And let's see what it is. $100. And the ending balance, folks, ought to be 4,900. And you can check your work. You can say, oh, it's the exact same thing what we did in the green box. So once again, this column here, retained earnings, same identical thing that we already did. No different. Now let's come here to the common stock here, folks. Now this is Fred's first month in business. He has never had this business before. And his common stock at the very beginning was 0. There was no common stock. But then if you recall, he issued himself, it was the very first transaction that we did, he issued himself $5,000 worth of common stock. And common stock, that is a representation of the ownership in the business, all right? So it's the how much the owners are investing into the business. Now, The next line is add net income, but we did that with retained earnings, so we don't have to do it again. Dividends, same thing. We did that under retained earnings. We don't have to do that again. So the ending balance is simply going to be the beginning balance of common stock plus what was issued is going to be our ending balance. $5,000. There you go. Now, if you thought those two columns were easy, the total's even easier. All we're going to do is add up horizontally. Just always add horizontally and you'll do it. 5,000 plus 0 is 5,000. 0 plus 5,000 is 0 plus 100 is, and just add across here. 5,000 plus 4,900 is 9,900. So there you go. So once again, you can do these two statements here. I mean, you can do them both if you want to, but I wouldn't. I'd either do it the way we did it in the green one here or this alternative format. I guess it's whichever way your teacher wants you to do it. So there you go. But now you know how to do it either way. Do you have to do both ways all the time? The answer is no. Just pick one or the other. And now we're coming down to the balance sheet. So what goes on the balance sheet? Well, the balance sheet is simply the accounting equation. It's assets equals liabilities and stockholders' equity. That's all it is. So cash. How much cash did Fred have at the end of the month? Well, all we got to do is look on our trial balance. Look at that, guys. Cash. $81.50. So all you do is write it down. Don't do any adding or subtracting. Just take the number off. But make sure you write it down correctly. Parts inventory, 1,500. Write down 1,500. Merchandise inventory, 4,000. Write down 4,000. Equipment's 3,500. Write down 3,500. And those were all the assets. So all we have to do is now total it up. Again, if you use Excel, you'll do this right. So add it up. I added it up, or Excel added it up for me. We get 17,150. There you go. Liabilities, coming down here to accounts payable. Well, accounts payable is 7,250. There you go. And folks, that's the only liability. He only has one bill here, 7,250. So that's the total. Coming down here to stockholders' equity. Now, with stockholders' equity, you would be wise if you went to these statements. Okay, here's the balance and retained earnings, and if you did the fancier format here, you've got the balance for common stock and retained earnings, right? So here you go. So the balance for common stock here, and we can also take it off our trial balance here, is $5,000. So let's get that. There it is, retained earnings. Now I've got that highlighted in blue because it comes right off of these statements. Look at that, retained earnings is 4,500, 4,900. It doesn't matter if you take it off the green statement or the pink statement. You're going to get the same answer either way, right? So here we go. There it is. And the total stockholders' equity, folks, here we are. And you can double check that number too. You know, that's the thing in accounting. You have to learn to double check your work. Look at this. The grand total, 9,900 right there. Well, the grand total for stockholders' equity is 9,900. There you are. Last step here, folks, and you don't want to drop the football on the 2-yard line and fumble, okay? A lot of students get this far and then they don't do this last step. And it's like, oh, come on. You're about ready to score a touchdown and you fumbled the football. So here we go. This is a balance sheet, folks. Total liabilities and stockholders' equity, folks. All it is, here's my total liabilities. Here's my total stockholders' equity. And all I do is add the two together. And I'm going to get rid of the split so it shows up a little bit better. Coming down here to where we're working. So here's the balance sheet. So check it out, guys. Total assets, $17,150. Total liabilities and stockholders' equity, $17,150. Look at that. It balances. So we can be assured that we're probably doing a very good job on this. So what did we do today, folks? Well, here's what we did. In a nutshell, really fast, we had a bunch of transactions. And what we did is we posted those transactions into the general ledger, the heart and soul of the accounting system right there. And we made sure that it balanced here, right? The left-hand side equaled the right-hand side, and then we did a formal trial balance. And these totals were different, but they do balance. And then we did our financial statements. And folks, you have to do them in this order. Don't do them in any other order ever. So do them in this order right here, income statement. And then you have a choice here. You could do the statement of retained earnings this way or do it the fancier way. It's up to you, either way. And then lastly, you do a balance sheet and you got to make sure it balances. And this balance sheet will balance. And if it doesn't balance, guess whose fault it is? That's right, it's yours. Not the accounting, not the problem, not the textbook. It's your fault. So make sure it balances. Make sure you transfer numbers correctly. All right? So there you go. So if this lesson helped you out, let me know. Hit the like button and the subscribe button. Leave a comment below. If you have questions, leave a comment below, and that way I can make a video on it. And until next time.